The Fed is in complete disarray. And as we highlighted in our last episode, drawing attention to actually Goldman Sachs' question, which was who's left to buy this 1.784 trillion of newly issued treasuries next year, really they were drawing attention to concerns that interest on this debt is going to rise exponentially to the point that it becomes the single biggest government outlay. Now, all of this ultimately leads to just one conclusion. The Fed will have to re-implement QE so as to monetize the debt and the deficit. And what the heck's that going to do to the gold price? And as we outlined in our last few episodes, this will be the trigger point for global banks to revalue their unencumbered gold reserves.
Andrew Maguire is a British commodities trader and whistleblower who, years ago, presented evidence to United States regulators alleging that fraud had been committed and that prices in the international gold and silver markets had been manipulated. Not surprisingly, Andrew named J.P. Morgan Chase as one of the large banks and financial corporations involved in gold and silver manipulation. Since then, the British investor and commodities trader has been educating the public about the activities of these banks, which he alleges are in cahoots with the United States government. Andrew alleges that the United States government has been for decades deeply involved in the suppression of gold and silver prices, essentially to take attention from these metals towards the US dollar and treasuries. For decades, the tactic worked. Not only did other central banks stop buying gold and silver, but they also started loading up on US bonds while also selling their previous gold and silver holdings. This allowed the U.S. government to accumulate a significant portion of its massive $33.7 trillion debt. However, Andrew warns that there has been a permanent shift that started years ago, evidenced by central banks repatriating their gold and then accumulating more gold and silver in recent years than at any other point in history. In addition, central banks like the People's Bank of China are dumping US Treasuries. If anything, this all proves that these central banks know something and they are preparing for something. According to Andrew Maguire, they are preparing for the global revaluation of gold prices and the commodities. Trader firmly believes it will begin in 2024. During a recent interview with Kinesis Money, Andrew explained the reasons for his firm conviction that all central banks, including the Fed, will begin revaluing their gold holdings within a few months. He began by pointing out that gold prices are at or near all-time highs in other fiat currencies, but declining when priced in dollars, a sign that the U.S. government is putting in a last-ditch attempt to further delay the inevitable. The inevitable in this case is the revaluation of gold prices, a process that could see the leading precious metals hit at least $10,000 per ounce. We will now bring you clips from Andrew's interview with Kinesis Money. Please watch, share, and like this video. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks and enjoy the video.
As our subscribers know, this process was kicked off following the Bank of International Settlements revaluing physical gold as a first-tier asset class on the 1st of January, which is when gold began competing against US Treasuries. Now, providing central banks, sovereigns, commercial trading advisors, and investors an alternative far superior, zero counterparty risk alternative, safe haven investment and hedging vehicle. Now, during the course of this year, this alternative safe haven pivot sparked the largest central bank sovereign physical gold demand in history, severely impacting available global supply. None of this is seen inside the casino. Market footprints evidences central banks hedging previously unfactored US Treasury tail risk by their actions is already weighing on Treasury demand. It's this lack of Treasury uptake that's actually been spiking the bond yields higher as central banks, alongside institutional investors who have a global view, seek real asset alternatives, which of course include cash, but also gold. And under the Fed's induced smoke and mirrors haze, every central bank, including the Bank of International Settlements, who 1 year ago, almost to the day in November 2022, bought back their entire gold derivative positions, concluded it on that day, taking advantage of the Fed's synthetic attempt to cap the dollar price of gold. Now, note, though, that despite the Fed's best efforts, exactly 1 year later, gold is carving out a higher stairstep, over $350 per ounce higher than the $1,618 point, the exact point the Bank of International Settlements covered the last of their bets against a rising gold price. Look, there's only one reason gold is carving out a higher stair-step to rally from in 2024. Every other global central bank, both Western and the entire global South, have been openly on record as well as surreptitiously off record buying physical gold. And this leads to just one conclusion. Global central banks are accruing physical gold so they can revalue this gold at close to the market price. And when any one of these central banks commences this process, it will trigger every other central bank to synchronize. And as soon as this happens, the Fed will have basically one of two options. They admit they've sold title to the Treasury gold to multiple parties. Well, clearly that's not an option. Or they're going to have to move to revalue this 831 tons of rehypothecated positions in sync with global central banks so as to avert what would be a foreign exchange imbalance. Bear in mind that gold's a foreign exchange cross. So it would create an FX imbalance, which would trigger multiple repatriation requests from other central banks requiring their undervalued gold to be returned for jurisdictional revaluation purposes. Now, if the Fed does synchronize to also value foreign exchange gold against the dollar, it would be the only way they could maintain their rehypothecation illusion, thereby averting unwanted repatriation requests.
Commodities traders like Andrew have been talking about gold revaluation for years now. Under normal circumstances, that would have happened a long time ago, especially to help the U.S. government get out of its massive debt load. But for some reason, the government is still trying to keep up the charade that all is well with the economy. According to Andrew, the consensus of first-tier liquidity providers is that this cannot continue for much longer. During the coming year, as the Treasury Department issues another trillions of dollars worth of bonds with reduced buyers and higher yields, they will have no choice but to revalue whatever is left of the gold in Fort Knox. During the interview, Andrew also discussed his outlook on current gold prices, gold and silver manipulation, and how gold revaluation will impact silver prices. Let's get back to the interview.
This is a massive opportunity, really, to capitalize on this window. But more immediately, for those looking to get on board, what we do see as we head into the end of the fourth quarter of 2023 is the Fed faced with dealing with massive rehypothecation of this 833 tons of pledged Treasury reserves, is aware that it's on the back foot. And as liquidity to maintain the paper gold illusion evaporates to unsustainable levels, the Fed, using in-house speculators to lay off this liability on, is as disruptively as possible trying to exit these extremely large, wrong-footed, undeliverable derivative market long dollar bets against gold, short dollar bets against gold. So now, given all of these bets are aggregated in the non-Basel III compliant US-centric COMEX cash-settled gold futures markets, the only place separate from Basel III compliance, is why we've been subjected to deliberately generated synthetic volatility. Now, volatility is what you use if you want to start gaming people who are blinkered to what's going on in the real world. The window for the Fed to cover what they can is closing fast. But look, silver's joined at the hip, and it's in the same hands as the gold actors that we're talking about. And as silver is not yet NSFR compliant, in other words, if you're providing liquidity into the spot market, you don't have to have the physical on hand. It's easier to influence silver than gold. So we look at these market makers' footprints in the gold-silver ratio trade, where silver is benchmarked against gold. So given at 87-1, which it was at the beginning of the week, is so synthetically divergent from where the ratio should be, 87 ounces of silver to buy 1 ounce of gold, we see silver as outperforming gold once gold is revalued. This is a hell of an opportunity. Now, looking very short term at silver, the ratio trade is looking attractive at current deeply suppressed silver levels. And while there's little doubt that silver could not be maintain offers to sell below 23 bucks spot into such large Indian and Chinese demand, it is also the case that regarding speculators held bearish options bet against silver at 24. So really we're seeing the speculators really sort of somewhere gaming between 23 and 24. Following the spec rinsing, the options sweet spot, we're talking about on the 27th of the month, it had lowered between 23 and the base as a base case and 24 as the top case. But given many of the short bets against $23 are speculator held and the house long against them, we may see some further fireworks as we get closer to options expiry on the 27th.
Andrew believes whatever rally or price gains gold has within the next few weeks will be the foundation for a greater rally that will begin with the precious metals revaluation in 2024. If the revaluation does occur, as Andrew is predicting, we could see gold prices quickly hit $5,000 and even $10,000 per ounce. Do you agree this is happening in 2024 or at a much later date? Please drop your comments in the comments section below, hit the like button, and subscribe for more videos on gold, silver, and other metals and commodities.